When companies consider expanding into Scandinavia, Denmark often stands out for its political stability, skilled workforce, and strategic location, but the real competitiveness of Denmark as a business hub is heavily shaped by its network of international tax treaties. In this video, we will explore how those treaties influence the way foreign businesses structure their investments, manage tax exposure, and plan cross-border operations involving Denmark. We will not walk through every treaty in detail. Instead, we will focus on the core mechanisms, practical implications, and what executives and investors should understand before committing capital to the Danish market. Denmark has entered into a broad network of double taxation treaties with a large number of countries, covering most major economies and many emerging markets. The fundamental purpose of these treaties is to ensure that the same income is not taxed twice, once in the source country where it is generated and once again in the investor's country of residence, while still preserving Denmark's right to tax income that legitimately belongs in its tax base. For businesses, this matters not just as a matter of fairness, but as a direct driver of effective tax rates, cash flows, and the overall attractiveness of Danish operations. At the heart of these treaties are rules that determine where income is taxed. For example, treaties define what constitutes a permanent establishment, essentially answering the question of when a foreign company's presence in Denmark becomes significant enough to trigger Danish corporate taxation. Without a treaty, even relatively limited activities can sometimes create tax exposure. With a treaty, the threshold is typically higher and more clearly defined. This allows companies to decide whether to operate through a subsidiary, a branch, or a lighter touch presence such as a representative office, with more predictability around the resulting tax obligations. Another major influence of tax treaties is on cross-border payments, dividends, interest, and royalties flowing between Danish entities and foreign group companies or investors. Under domestic Danish law, certain outbound payments might attract withholding taxes. However, treaties commonly reduce or eliminate these withholding taxes when the payment is made to a resident of a treaty partner country, provided specific conditions are met. For foreign investors, the difference between a 0% and a 15% withholding tax on dividends can materially change the after-tax return on a Danish investment. This is why holding company structures often route investments through jurisdictions that have particularly favorable treaties with Denmark, provided that the underlying business rationale and substance requirements are satisfied. Treaties also have a significant impact on how cross-border financing is designed. Interest payments from Denmark to foreign lenders may benefit from reduced or zero withholding tax under many treaties, making it more efficient to fund Danish operations with intra-group loans or external debt from treaty partner jurisdictions. Similarly, royalty payments for intellectual property, such as technology, trademarks, or know-how, can be structured to leverage treaty benefits, though authorities increasingly scrutinize artificial arrangements where IP is parked in low-tax jurisdictions without sufficient substance. As global standards evolve, Denmark has been active in implementing anti-abuse provisions, including those derived from the OECD's base erosion and profit-shifting initiatives and the multilateral instrument, meaning that simply relying on a favorable treaty rate is no longer sufficient. Multinationals are expected to demonstrate business purpose, economic substance, and real decision-making in the jurisdictions they use to access treaty benefits. Beyond withholding taxes and permanent establishments, tax treaties also shape transfer pricing practices. While transfer pricing rules exist in domestic law, treaties typically include provisions aligned with the arm's length principle, giving companies a framework for pricing intercompany transactions involving Danish entities. Moreover, most treaties provide mechanisms such as mutual agreement procedures, allowing tax authorities in Denmark and the counterpart country to resolve disputes and eliminate double taxation where both jurisdictions seek to tax the same income. For companies, this dispute resolution framework adds a layer of protection and predictability, helping to manage the risks associated with complex cross-border value chains. Another critical dimension is the interaction between treaties and Denmark's domestic participation exemption regime. Under Danish law, qualifying shareholdings may benefit from an exemption on dividends and capital gains, making Denmark an attractive location for regional or global holding companies. When combined with a strong treaty network that minimizes withholding taxes on inbound and outbound flows, Denmark can serve as a tax-efficient platform for owning and managing international subsidiaries. However, The availability of these benefits is increasingly conditioned on meeting anti-avoidance rules, including tests for beneficial ownership and principal purpose. Multinationals cannot rely on purely formal structures with minimal real activity and still expect to secure full treaty advantages. From a practical standpoint, when foreign companies contemplate entering Denmark, one of the first analytical steps is to map their home country's treaty with Denmark and assess how it applies to their specific business model. Key questions include: will the planned activities create a permanent establishment in Denmark? How will profits be attributed between Denmark and the home jurisdiction? What withholding tax rates will apply to repatriated profits, interest, and royalties? And how will transfer pricing policies align with both Danish regulations and treaty standards? By answering these questions early, companies can make more informed decisions about their legal structure, financing mix, and supply chain configuration. It is also important to recognize that treaties are not static. Many of Denmark's treaties have been or are being modified through the multilateral instrument, introducing provisions such as limitation on benefits or principal purpose tests that restrict treaty access where arrangements are mainly tax-driven. For businesses already operating in Denmark, this dynamic environment means that legacy structures designed a decade ago may no longer be optimal, or even compliant, today. Regular reviews of group structures, cash flow patterns, and treaty positions are becoming a necessity rather than a luxury. For investors and executives, the key takeaway is that Denmark's international tax treaties are not just a legal backdrop, they are a strategic lever in business planning. When used responsibly and in alignment with genuine commercial objectives, they can lower the effective tax burden, improve certainty over cross-border operations, and enhance the overall return on investment. However, the bar for demonstrating substance, transparency, and alignment with international standards is rising. Companies need to combine technical treaty analysis with a clear narrative about where value is created, where people and decision makers are located, and how the Danish footprint supports their broader business strategy. In summary, doing business in Denmark is deeply influenced by the country's extensive network of international tax treaties. These treaties determine how and where your profits will be taxed, shape the cost of moving capital and intellectual property across borders, and provide mechanisms to manage disputes and reduce double taxation. As you consider Denmark as a destination for expansion, holding activities, or innovation, it is essential to integrate treaty analysis into your early-stage planning, engage with qualified tax advisors where needed, and ensure that your operating model reflects both the letter and the spirit of international tax rules. By doing so, you can leverage Denmark's advantages as a stable, treaty-connected economy while managing tax risk in a disciplined and forward-looking way.